Imagine a portfolio designed not just for returns, but for resilience, surviving every market storm and thriving in sunshine. This is the intersection of modern portfolio theory and Howard Marks' wisdom, a blueprint for building wealth that endures generations. Modern portfolio theory, pioneered by Harry Markowitz, gave us a simple but powerful idea. True diversification is more than mixing stocks and bonds. By combining assets that behave differently, you can actually tame volatility without sacrificing growth. Picture a team of experts, each with unique skills, working together so the whole is stronger than any one part. Markowitz framed risk as volatility, the ups and downs of the market. But Howard Marks, co-founder of Oaktree Capital, sees risk in starker terms, the chance of losing money permanently. He cautions, you can't predict, but you can prepare. Preparation means building portfolios ready for any market. It's not enough to diversify. You must manage emotions, understand cycles, and adjust when conditions change. Modern portfolio theory gives us 4 cornerstones. First, the risk-return trade-off. More return usually means more risk, but the goal is smart optimization, not unchecked ambition. Second, the efficient frontier. Seek portfolios that bring maximum returns for each level of risk. Third, diversification. Blend assets with different risk patterns to smooth the journey. Fourth, asset allocation. How you split between stocks, bonds, and alternatives matters more than any single choice. Howard Marks adds nuance. For him, real risk isn't the market dipping. It's the devastation of irreversible loss. Downturns come and go. The losses you can't recover from are what matters. Instead of timing markets, he advocates dynamic risk control. When markets are euphoric and expensive, play defense. When fear is rampant and quality assets are discounted, play offense, but always with discipline. How do you put these philosophies to work? Here's a 5-step playbook for generational wealth. First, balance offense and defense. Pair aggressive assets like equities and innovation with stabilizers like bonds and gold. Adjust that balance as cycles evolve, but keep the philosophy steady. Second, diversify widely, from asset classes to geographies, sectors, and investment styles. Blend value with growth, large caps with small caps, domestic with global. True diversification avoids over-reliance on any one bet. Third, make risk control your anchor. Limit leverage, focus on what you deeply understand, and prioritize position size and liquidity. Protecting capital is as vital as growing it. Fourth, rebalance regularly. Markets and your portfolio will drift. Scheduled rebalancing pulls you back to your intended risk level and long-term aim. Fifth, think in decades, not days. Generational wealth grows with patience, not reaction. Time rewards discipline, letting compounding work its magic. Consider a simple approach. Say your portfolio is 60% equities, 30% bonds, 10% gold or cash. If markets run hot and valuations soar, you might shift to 50-40-10 for safety. When fear takes over and bargains emerge, rebalance toward growth. Each tilt is deliberate, not guesswork, an evolution, not a gamble. In essence, modern portfolio theory gives you the map. Howard Marks hands you the compass. Math sets your direction. Mindset keeps you on course. Used together, you build a dynamic, resilient portfolio primed to survive downturns and capture upside, enabling wealth that lasts beyond your lifetime. To take control of your financial future, start thinking like a portfolio architect. Build with both science and sense. If this deepened your understanding of portfolio strategy, share your feedback and let us know what you want to explore next. Disclaimer: this content is for educational purposes only and does not constitute investment advice. Consult a registered financial advisor before acting on any strategy.